Welcome back to my channel, Balance Sheets Matter. Today we're going to be looking at Archer-Daniels-Midland's company. This was a subscriber request, so we're going to do a stock analysis on Archer-Daniels-Midland's company. But before we get into the analysis, of course, make sure to subscribe to my channel, Balance Sheets Matter. I do individual stock analysis videos, so if you want to get ideas for potential stocks to buy or value traps to avoid, make sure to subscribe to my channel because I'm putting out new videos every week. And now let's get into the analysis here. So I always first like to look at some of these just like top overall metrics on Guru Focus. First of all, we kind of look at the Guru Focus value band here. It is saying this potentially could be a little bit undervalued, but we're going to see if that's true or if this is actually a value trap. And then we see basically the P ratio right now is sitting at 9.79, which might be some of the reason people are interested in this. It is looking quite cheap, but they do have a forward PE of 10.92, which is indicating their EPS would be dropping in the future based on the analyst estimates at least. Also, their dividend yield is sitting about 2.4% with a payout ratio of 2.3. And before we get into the financials, I'll just give you a little bit of background on this company. Basically, Archer-Daniels-Midland, they're kind of in the agricultural industry, wheat, oils. They're a producer, they're a transporter, they're a seller. They also have basically a little commodities trading desk where I think they're, facilitating hedging for others and doing even some hedging themselves. So they have a lot of interest in everything about the commodities related to like wheat and oils mainly and other stuff too. So they're quite a big company in the market for that. So let's dive into the financials here. So first of all, you can see on this the revenue trend here. They do get these big boosts and then you do look at these plateaus and drops. And this is pretty typical with like companies that are linked to commodities. They're going to go with the price of the commodity. So if the commodity is basically going up, the revenue is going to go up. If it goes down, it's going to go down. As you know, with the kind of now somewhat recent, but it's been going on for a while, the war with Russia, that caused a lot of like wheat prices to go up from the supply chain disruptions and this and that. So that could be the reason for a little bit of the boost in revenue they've had over the short term at least. So if that does go away and commodity prices do come down, you probably would expect revenue and potentially earnings to come down as well, as we'll see in the financials here. So sometimes I like to look at basically the return on invested capital over the weighted average cost of capital, but you'll see after 2010 here, return on invested capital dipped. And this is, I'm pretty sure, based on like at least their balance sheet there, it's because of their involvement in whatever they're doing around basically commodities, like futures and hedging and whatever, services they're offering around that. When you start getting into more financial products like that, or you have like loans on your balance sheet, or you're an insurance company of some type, it's going to throw off your return on invested capital. So it looks right now it's like really bad. I think this is a little bit inaccurate because of the actual business they're in. So this is just one of those things, again, when you're looking at return on invested capital, you have to actually understand what the company is doing. And I don't think it's too applicable in their current state, as I'll show you a little bit later. But you can see revenue over time has gone up, although if you look at basically from 2008 to 2020, it actually went down a little bit, and it was only this recent boost. And this gets into this cyclicality because from 2008 to 2013, they had a nice boost of revenue, then it contracted for a while, now it's going up. Over the long term, it has been going up. Gross margins, they've been fairly consistent, basically on the low range, 4%, on the high range they're getting 6%, but because of the recent war and the other economic factors going and the higher price of wheat, well, they've been catching a higher gross margin. I honestly would not expect this to stay around forever. I would expect them in the long term to more revert to this norm around 5-6% effectively. And then we can kind of see the same trend with operating margin. Operating margin's been low as in the low 2% range up into the mid 3s. Right now they're sitting at a little bit of a high of around just over 4. So I would expect this to revert back down. And in the last year, they have had nice operating income of just over $4 billion. And this is really good because their net interest income here is only $80 million. And you can see basically there has been times when it has been basically higher in the past. And right now, I think it's a lot because of their current assets they have, the higher Fed funds rate, they are able to make more interest income. But even if they had one of these higher numbers back here, this is still a pretty good income, like interest to income coverage ratio. Basically $80 million over $4 billion is extremely good. And even if we look at their, some of these other more average years, we'll take out this 1 year right here, but if you have $200 million over $2 billion of operating income, that's very good. This is speaking to a relatively pretty overall strong balance sheet. They're not having any trouble basically paying their debts, and they probably have relatively not very much long-term debt overall with their relatively low interest expense they are paying. As we go down, you can basically see net income. It fluctuates up and down. This is the thing with these cyclical companies, and why typically sometimes when they are expensive, that's why they basically look cheap, because the income will go up and then it can basically come back down. But they are at a little bit of a high right now of over $4 billion. So we're going to see, again, I think if that net margin comes down, the operating margin, the gross margin, all of the margins come down a little bit, we'll see this net income come down as well. And then you can see, again, EPS has been creeping up over time. Is pretty stable overall. You're never actually having losing years, which is really nice. And that's also one of the reasons why the EPS has been going up, is because they have been buying back some shares over time as well. Not at a ridiculously fast pace, but basically it looks like over just almost 15 years here, they bought back 100 million shares out of 646 million shares, which is not bad. So it's returning some capital to shareholders with there. And we already know they pay a nice little dividend as well. So let's jump into the balance sheet. You can basically see current assets are sitting at $30 billion. And again, I think what you're seeing here from this jump to 2010 to 2011, which I was saying on return on invested capital, it went from just under $3 billion to $9 billion. I think this is related to their commodities trading business, or they're doing it for brokerage. It's a brokerage business, a commodities brokerage business for others, basically, along with some of their own hedging. So I think this is basically adding to that. That's what we're seeing there. But overall, $30 billion in current assets. We compare that to their current liabilities, just under $19 billion. So they have a very good current ratio, basically lots more current assets than current liabilities. And again, you can basically see this same jump in the other current liabilities, and from that 2010 to 2011. Overall, total assets are sitting in just above $55 billion. There is these intangibles of $6.5 billion. Right now, I think it's just my guru focus isn't bringing up actually the goodwill, but I think the goodwill actually probably is realistically actually sitting at that $4.1 billion. So we're going to need to basically take that out at the end, because that's not a real tangible asset we have. We're also going to need to examine if these assets themselves, based on how their depreciation schedule, if it actually is a real assets they have, or if they haven't been depreciating them fast enough. And you can basically see total current liabilities only sitting at $30 billion. Relatively low long-term debt, only $8.2 billion. And it's kind of funny because over 10 years ago, they also had only $8.2 billion. So they've grown their revenue a lot, and they really haven't taken on any more debt, which is a pretty good sign overall. This company hasn't had to issue shares. They haven't had to take on additional debt. It's overall so far looking like a very good, profitable company. It's just one of these things you want to buy at the right time because of the cyclicality for it, which we're going to get into a little bit later. And that basically leaves us with total equity of just over $25 billion, but you can take out all of the intangibles or just the goodwill. That leaves us around $20 billion of total equity on the books there. And also, I just forgot to mention, so we're just going to go back here to the summary quickly, but the total market cap is only $39 billion. So in a relative analysis, especially for kind of more of a commodity-driven cyclical business like this, we're actually going to look at the price-to-book value, because that is a way we can start valuing companies like this as well to see if they're a good value. So let's go down to the cash flow statement. So again, let's just see if the assets we're seeing on the book are really real, or if they haven't been depreciating them enough. So you can basically see cash flow from depreciation. It was around $700-800 million back in 2008, 2009, and it slowly crept up from the 800s to 900s to about $1 billion now. And in comparison, the purchase of plant, property, and equipment has effectively been at a little bit of a higher rate. So the assets we're seeing maybe are a little bit overstated compared to the replacement, or you can kind of factor this in that they have been growing their revenue, so they are going to have like more purchase of plant, property, and equipment there. But overall, there's a lot of years when it was basically completely in line. There's a few years when it's a little bit higher. This is making a pretty minor impact, I would say. So I wouldn't factor in too much, but you can maybe take from the total equity a couple $1 billion off, just to be fair. Also, basically in the purchases business here, they have been purchasing a lot of businesses. This also probably does help relate to their overall growth and the different business segments they're getting in. And they do some little ones, they do some of these big ones here, but overall they're kind of consolidating the industry. They're getting a big moat in it, and overall from we see all the other financials, they're very profitable and things are going pretty well. We'll just take a quick look. Stock-based compensation, it's a little bit, not much, really not relevant to be looking at for this. That's usually only a problem in tech companies. And now you also do want to check out this line here in purchase of investments and sale of investments, because I think this relates to their own personal commodity hedging, which is very common in basically commodity businesses, especially if you're a producer. When you produce it, you want to kind of lock in that price and not potentially be selling it at a loss in the future, and it looks, or it might be related to their commodities brokerage service as well. I'm not entirely sure, but overall they've been doing very good at it. You can see basically some years there's minor losses or minor wins, but basically from 2016 going forward, they did extremely well in making some big profits. And this is important because if we just go down to the free cash flow here and you saw, oh look, the free cash flow negative, they're losing all this money here. Well, free cash flow doesn't include this activity from their investments here. So once you add in the investment activity, this free cash flow is actually not as negative. It's actually positive in a lot of the cases. So it's a little bit deceiving in that way. So that's just something else to understand. You can see they have basically been returning capital to shareholders through the repurchase of shares, although it is a little spotty. And this gets into the kind of cyclicality of these companies and why share repurchases for some companies is not always the best way to return capital to shareholders. Although if you're kind of an investor like me who likes waiting for companies to get cheap and then selling them when they're expensive, it can help actually create that. So let's just look at this from 2014 to 2016. That's when they were doing all the repurchase of stock, and then it kind of depleted down until 2021 and they started doing the last 2 years. Now let's basically look at the little stock price here. So 2014, 2016 here, stock was going up and they're basically purchasing the majority of it at the highs. And then after this point here, when it's down, they're not buying back any stock. And then they start buying back stock up again here. So this adds to a little cyclicality that we might be getting a little sideways consolidation going on in the future. We can also see cash flow from dividends. They've consistently increased it over time. It's relatively, they're not paying out very much, and that's typically they'll just cut back the share repurchases instead while keeping the dividend payout ratio is relatively low. You look at a comparison to basically any of these other years of free cash flow, it was just fine. So I wouldn't expect them to cut their dividend, and they probably will continue increasing it over time. Now let's pop into the interactive chart for a little bit of a relative valuation to see what a good price basically to buy ADM could be. So let's bring up the revenue with estimate and the EPS with estimate, which is just basically a combination of all the analyst estimates combined there. And as you can see, they are expecting it to kind of trend down over time, although I wouldn't take these exact numbers too seriously, because again, this is a company that's going to be heavily linked to what the actual prices of the underlying commodities they're involved in, such as wheat, are. So some people may be estimating high, others may be estimating low. So what they actually are is going to really actually vary what these could be. But overall, everyone is estimating they are going to go down a little bit, which I was kind of hinting to earlier from a lot of the other factors we could see. It did look like they're maybe at a little bit of peak income and a little bit of peak margins right now. So it would be expected to see those potentially come down in the future. But let's basically look at the price to sales ratio to get a relative analysis here. I'm going to bring it up to 25 years. And you can see again, this overall, they kind of do relatively track the stock price, tracks a little bit with it when the price to sales ratio is at lows, stock price is lows, and vice versa. Right now, it's kind of sitting in this middle zone here. It's not really low, it's not really super high, but basically if the sales were to come down, this would actually indicate it's a little bit on the higher side, even like that. But let's basically see if it's actually a good way to look at it. I want to bring up the net margin to kind of show you the past of it. And you can see right now, there has been other times when basically the net margins got very high before. A little bit ominous. This is right before the great financial crisis when they had their little peak there. And we're getting something like that again. Could that be some foreshadowing for the overall market? Well, we won't know. But overall, it would be expected that they're going to come back into more of this historical net margin area. And this has been pretty consistent overall for the company for their net margin. So I would say the price to sales ratio is a good way to look at it. And frankly, I would want to be waiting for it to come down more into this 0.3 range right here, because this would have been a good time here, good time there. It got a little bit cheaper here, but overall, this would have been, more buying the dips, buying it at basically a good price. And now let's look at the next one, which we're going to look at the dividend yield, because when you do have a consistent dividend payer like this, that seems to be pretty consistent, increasing relatively with your business over time. When you do get the spikes in dividend yields, that can indicate that the stock's relatively cheaper, as you can see with the chart in front of me right now. And right now, we're not at an extreme high right now, but we're definitely not at a dividend spike right now. It looks like from all these previous spikes, it can get above 3%. We're at about 2.4% right now. So I wouldn't be looking at Archer-Daniels-Midlands here until it basically got over a 3% dividend. That'll be one way also kind of confirming it's at a relatively good valuation, which right now we're not quite there yet. Also, as I said, price to book ratio, because the company does have some assets on their balance sheet, and these cyclical companies, you kind of can't value it. You can see actually this is another great relative way to value the company. Every time the basically price to book ratio got closer to 1, it was a really good time to buy the company. So let's just get rid of the price here so we can look at just the price to book ratio, and you can see if we get a little bit closer to 1, a little bit under 1, that would probably indicate it's a good time to buy this company. Right now we're sitting at 1.58. That's a little high, so that's kind of indicating it could be on a little bit of the more overvalued or fairly valued, depending what your idea of overvalued or fairly valued is. So let's get into a little bit of technical analysis here. As you can see, it already started drawing some things here because I'd actually recorded this video, but I wasn't recording the whole time. It turns like I was just talking to my computer, so they're already there. But overall, you can see that the stock has been this very long-term uptrend. They are a very good, profitable, sturdy company. You just want to buy them at the right price. And they kind of do ride these monthly moving averages. And effectively, every time they have come into these lower moving averages, either the 150 or the 200-month moving average, that has indicated it has been a good time to buy it. And from what we're seeing on the fundamentals, the relative analysis, I think that all applies again right here. And we can see as we dig a little bit more into kind of the technicals here, you have this big support zone here, this big price volume profile. This big run up here was done on a relatively low volume. So this area down here, especially into basically mid to high 40s, is going to start serving as support. And I think that's where the demand for the stock will be. That's personally where I would be looking at buying the stock, because I think it would be a great deal then. And for a company like this with a big moat, good consistently, overall good financials, you really just want to kind of buy it at the right price. Because if you buy it right now, just like if you bought it in 2014, 2015, you could be buying it a high and be big, holding it for a long time. You would receive a little bit of a dividend, but it would kind of be dead money. So if you can buy the stock when it is cheaper, I would be aiming for these mid $40 price targets here. And from that, you're going to collect probably a good dividend and also potentially get some good capital gains. So that's my opinion on Archer-Daniels-Midlands. I hope you enjoyed the stock analysis. Make sure to subscribe to my channel, like the video, and I'll see you in the next stock analysis.